So I'm in the camp of Fed has to cut, and you're in the camp of Fed should not cut.
They don't need to cut.
Okay, that's what we're arguing about today. We're gonna take different views.
All right, let's start arguing about the Fed. And I don't care what they do, but the market's saying they're cutting. So
you
here
are
we
arguing that they are not cutting.
I don't care what they do. Okay, the 30 years not going to change either way.
For this segment, you are arguing that they're not cutting.
No, I'll do whatever the hell I want. I might surprise you and Zach. Welcome to episode 71 of Talk Your Chart. I am Marco Segrera here with my partner in crime, Brett Horowitz. It is September 2nd, noon. Later recording today because I got physical therapy on my elbow and ankle. Thank you, Brett, for being so gracious with your time. I know you're sensitive to getting food in your stomach, so let's keep it moving, please. I know. So my first chart, which might be my only chart, I don't know. I'm going off script today, like I told you. My first chart is one showing the S&P's performance following rate cuts. Brett, why do you think I brought up rate cuts? Because the market's about 86% positive that we're going to get a cut, the first one after the hiking cycle in September of 25 basis points. And I don't think that our good friend Jerry needs to cut. I know that the market's pricing it in. It's all but a truth. But I just want to go through a couple points here, and then I'll have more others as to why maybe a cut's unnecessary. Number one, BH, wealth effect. Bull market has boosted household wealth to record levels. 62% of Americans are now invested in stocks. It's the highest since 2008. That is an incredibly positive impact on consumer balance sheets, and it's more than offsetting the drag from rising credit delinquencies, which are not even flying off the charts. Economy, Q2 GDP.
Wait, hold on a second. So now that the highest percentage of people own stocks, now you want to have the market just take a dip when the Fed doesn't do enough with the rate cuts or doesn't do a rate cut?
I just can't believe you cut me off. I'm trying to get my points laid out to steelman the case for why a cut is not necessary.
Okay, you want to do damage to the entire economy. Go for it.
As this guy's acquiescing. What damage? You mean because, second point here, Q2 GDP was revised up to 3.3%, and incomes are not climbing faster than that?
Companies averaging 1.4% for the first half of the year? Because it was negative in the first quarter.
But what's coming? What are the trend lines telling you? And then wait a second.
Okay.
Businesses are sitting on record cash, $4 trillion in cash. At the same time, layoffs remain low, and new claims also not popping off a chart as we're talking about the labor market. I just don't see it. And then the cost for businesses are rising at the fastest pace in nearly 2 years. So this is the whole inflation issue. And I'm going to put a little bit more color on the inflation point. This is from Goldman, right? So this is Goldman's analysis suggests that the latest tariff hikes will push the core PCE, the Fed's preferred inflation gauge, up by 0.66 by year's end. That would lift the annual core PCE rate to around 3.2%, well above the 2% target. In June, it rose 0.3% from the prior month, and it's up 2.7% in May. And then also, just big picture is 11% additional inflation since January 2020. So we're basically 11% above the 2% trend line. So we're sitting at 322.1 on the CPI gauge instead of the trend, which would have been 289. So if you're the Fed and you're going to keep this 2% target, shouldn't you just be sitting and adhering to your target and not cutting until you get back to what trend was?
Your chart makes a good point that if the Fed does cut, we should have some good returns going forward. They're obviously in a tough spot with a dual mandate because you have an employment that's looking very, very weak, but you have inflation that's very hot. So I think without a doubt, what they do, whether they do it or don't do it, they're going to get blamed either way. It's tough for them to get this perfectly correct. I've got a lot of points to make as to why they should do it for a lot of weak things out there. But agree, it's not like it's a slam dunk, even though the market wants it to happen, of why they should do it.
ISM's under 50. This would be the first ever recorded recession with a starting ISM under 50. What weakness, what labor market weakness do you want to talk about?
Okay, yeah. Okay, I'm getting to the real deal here. What's underneath these? First thing, first chart, the share of U.S. imports that were duty-free by origin. So, Marcos, why haven't tariffs spiked inflation? I know what you're going to say. You're going to say that China has rebranded themselves as Ohio to get out of the tariffs. Then they raise prices 100%, then drop them by 90%. And everyone's like, what a great deal. Prices are down. That's not the case. Okay. You were going to say something else?
I was going to say that businesses have taken on 64% of the cost.
Yes.
So foreign exporters, 14%. U.S. companies, 64%. U.S. consumers, 22%.
That is part of it. The other part is that a Barclays economists basically looked at this and said most companies and consumers bought less from countries that had high tariffs. So this was either a combination of, number one, buying stuff before the tariffs went into effect, right? That's why GDP was negative in the first quarter.
Yeah.
And now also buying stuff from less companies and moving stuff around so that we're not hit with China, which has the big tariffs, and India and things like that. So they basically, Barclays said that the weighted average of the tariffs is 12%, much lower than what they thought it would be when this announcement first came out, and much lower than what it was feared to be. And they expect that to go up to 15% because they said it's hard to separate from China, even though so far we're doing a good job. But what happened on Friday? Tariffs are illegal. They can't be made this way. Can't be done this way. So at that point, all this inflation that we're worried about, if this stands, is going to go away. So you got to cut. Inflation is not a big deal. Point number one.
Labor market's not as ill as I think folks are saying. And what's going to end up happening if you cut rates, everyone thinks, awesome, you cut rates. Now my 30-year mortgage is going to come down. It's not going to move. And your treasury is going to go up.
We need to talk about housing prices, and we need to talk about mortgages. Okay? Chart number 2. Okay? Likelihood of workers switching employers in a given month is down. Also, the share of Americans moving annually down to the lowest figure in 77 years. So in the 50s and 60s, 20% of Americans moved every year. That number is now down to 7.7%. What is the impact of that, Marcos? That's what you're going to ask. I know. The impact is that because people are not moving, you can't convince people in other states to work for you. People are stuck where they are. You've got a lot of couples now that have 2 incomes, that they need 2 incomes in order to afford their house. So they can't pick up and move. And so as a result, people are stuck. They're living in places they don't want to live, in houses that are too big or too small. And as a result, you have a labor market that's so weak that you need to get people moving. Lower cuts.
No, I hate that second chart so much. There's clearly a trend that started in 1995, but the ability to take a job and do it from anywhere is putting crazy downward pressure on this without a shadow of a doubt. Housing's broken, and what people used to do is move to Arkansas. But guess what? I don't want to move to Arkansas.
Whoa, you're offending all our Arkansas clients. Like, it's probably pretty nice over there.
So workers switching employers in any given month. Okay, that's fine. That's stable. That's not telling me anything. When it's up, it's loose. When it's lower, it's tighter. But this isn't falling off a cliff. Where's my chart of continuing unemployment claims and new unemployment claims?
It's low. I get it. It's low. But if you have a job, you're going to keep a job. If you're looking for a job, it's very hard to find a new job.
But that has to do with the skills mismatch more than anything else.
That's part of it. It's also because people just can't get up and leave because they've got the golden handcuffs in with their nice mortgage rates. You ready for my third chart? Put the icing on the top of this cupcake here.
Don't tell me it's about card spending.
Third chart has to do with credit card and debit card spending. Listen to this. It's scary, okay, what's happening. So a few years ago, credit card balances hit $1 trillion. Thankfully, that has come down. How did it come down? Because people paid off their credit cards, but they also took out all these personal loans. Personal loan, credit card consolidation, debt consolidation, home equity. They put it all in different places. So now they have all this debt in other places. Credit cards are down, thankfully, but it's still a big issue. So, for example, now they said that personal loan originations jumped 18% in the first quarter. There now is $257 billion of personal loans. Many people then take those loans and refill their cards within 18 months. And the share of Americans making a minimum payment is near a record. Okay? We need rates to come down on credit cards. We also have all the debt being paid off now that people are doing that they didn't have to do before. We need rates to come down. I rest my case.
Yeah, I don't think we need rates to come down. I think they're probably going to cut. So what's the ultimate downside? Again, the reason why I'm making a case to begin with that we don't need it is because of the excess inflation that we've had since 2020 and being 11% off trend. What'll also most likely happen if you do have stoked inflation fears, while they're currently anchored, if you get a drop in rates, you're going to see long-term rates for the U.S. jump up. And that signals inflation worries and ability to service longer-term debt is just not as simple. So you're going to get an environment where you're going to see the Fed cutting 25 basis points if it so chooses. Everyone's going to look at the 10-year. Everyone's going to look at the 30-year mortgage. Everyone's looking at the 30-year treasury. And when those go up or don't move, everyone's going to say, hey, wait, what gives? And this is just how that works when the market is signaling, hey, we're more concerned about the cost of capital for the U.S. over the next 10 years and beyond versus a labor market crisis right now. And I
So
think
you want to let the bond vigilantes control everything, and because they're nervous about what could happen, which may or may not even happen in real life, you want them to have all the power here in saying, because they will impact and hurt rates and rates will rise, we can't do that even if inflation never actually comes out? That's the thing. You're worried about something that might not happen.
Yeah, no, I hear you. I don't think that a 25 basis point cut does the job in any direction.
No.
I just think the bigger concern isn't the labor market right now, at least as you look at the data. And just look at the stock market rally also as kind of a good example. This has got to be one of the most hated stock market rallies in existence, which is usually probably coming from people who are not participating in it. But that in and of itself, the fact that everyone's so kind of worried this is a fake rally, are we at the end of a bull market, just screams that we're probably more early cycle than we are even mid or end of cycle. If you look at the bull bear indicators, if you look at the investors accredited, whatever it is study, everyone's kind of bearish, which signals what? Upside and good things.
8%, 82%, wherever the number was, of companies beat earnings in the second quarter. Like, this is not a dot-com bubble where no one's making money. Companies are making money.
I know that I understand entirely, and I'm never going to bet against corporate America, but you're cutting into that environment. I don't know. And then here's the bigger take. The Fed shouldn't set interest rates anymore. So yeah.
You're going to get a lot of hate mail on this, but
And the Fed, it's overstayed its party. It meets once a month, looks at month-old data, and then 11 of them are like, here's what I think.
so you have a better strategy?
Let the market determine. Do you know how a treasury auction works? The treasury goes to market and says, hey, give me bids. So all the banks, knowing all the information they know, say, here's what I'm willing to pay, which turns into a yield. So the market gets to set that, and then use kind of the Fed funds rate as kind of like a benchmark. It's kind of useless.
And so when everyone piles in or out of something because they're either short or long and they're trying to help their own portfolio, and the interest rates skyrocket, and next thing you know, mortgages are at 15% because someone's manipulating the market temporarily, what are you going to say then?
That's so silly. That would get priced back down like it did.
Eventually, but not if you're buying the house that week.
No, oh my God. No, the big issue with mortgages is the spread. It used to be historically about a 1.7% spread. Right now we're sitting around 2.1. So just don't touch rates and let my spread come down, please. But in all honesty, I don't think a 25 basis point cut is going to do much of anything. I understand the desire of wanting to cut because it feels restrictive, but I just don't think the market needs it.
You were against the people. I'm here for the people to make sure that they can move and pay down their credit card balances and not have giant tariffs.
Oh, God.
Man of the people right here. You heard it.
Pay your credit cards off. All right.
We shall see 2 weeks. We'll find out the news.
We will. Go eat your lunch, Horowitz.
Thank you. Talk to you later.
Until next time.